All right, some more bottom fishing with Zachary Karabell, Jeff Kleintop, and Peter Schiff. One place there's not a lot of bottom fishing is the bank sector. We have a quote from Senator Chuck Schumer, talked earlier today on CNBC. Please take a listen.
A much better solution, in my opinion, which is somewhat modeled on the bad bank, is not for the government to buy the assets, but rather to guarantee them, and guarantee them below an amount that the banks now have them in their books. So if the asset was originally 100, the bank is valuing it at 80. It would be guaranteed if it fell below 65.
All right, Zachary Karabell, were you tuned into that one? Did you hear it?
I heard it.
I want to get your response to it. A, what do you think? But B, what's it mean for stocks? Because I worry a little bit that the stock market, the bank aspects, but maybe the whole market, somehow thinks it's going to get this magical silver bullet, a government-backed bad bank that's going to relieve commercial banks of all the toxic assets, and we're all going to live happily ever after with new loans.
You know, I think unless Congress focuses a little bit more on the underlying issues of the mortgage resets and the million plus or could be $1 trillion worth of mortgages that may reset this year, that's as much of an urgency that no one seems to be talking about. You know, I know there's a lot of debate about bad bank, not so bad bank, what to do. Creating some sort of backstop where assets don't continue to get eroded and downgraded that have some sort of intrinsic worth, because as you've pointed out many times, 93% of Americans are current on their mortgages. Yep. A lot of the assets in these toxic assets aren't so toxic. So finding a way to stop that is in fact essential. And I'm a little bit worried that people are going to be just arguing for the next 4 weeks about this rather than creating some sort of foundation so we can move on.
Well, Peter Schiff, what do you make of that? I mean, it sounds from what President Obama said yesterday, what Senator Schumer, who's an insider on this, said today. There is not going to be a government-backed bad bank to buy toxic assets. And I might add editorially, I say hallelujah. But I want to ask you, Peter, if you get a separate breakout into some kind of special investment vehicle by the banks of their lousy assets and the FDIC and/or the Fed guarantees them, is that a solution, Peter?
I don't think so. I mean, as an investor, I still wouldn't want to participate in the banks. I still think that whatever value is there is being confiscated by the government, and I think there's a lot more problems. You know, you mentioned earlier in the program the rise in interest rates. I don't think that's a good thing. I mean, if you look at what's happening in the bond market, we've finished January, and this is already the worst year in history for treasuries. And if you look at the momentum there, I mean, we're at 3.6% now in the 30-year. We were at 2.5% at the end of December. We could be back up at 4.5% pretty quickly. And if we take out 5.5% before the end of the year, that's really going to create additional problems for the financial institutions, because now we're going to have rising interest rates and not falling interest rates, and that's going to make all these bad loans much more problematic.
Well, that's an interesting point, Jeff Kleintop. I'd like you to react to what Peter Schiff just said. Now, there's two ways to go, or maybe both. One is that those rates in the Treasury market are backing up because the Treasury is going to have to finance the largest borrowing in the history of the planet Earth. Okay. It's also possible, though, Jeff, that there's a credit thaw going on, and the rush to riskless investing is coming to an end, and it could mean a big stock market rally ahead. Which do you choose?
I think it's more the latter, Larry. Even though yields in the Treasury market did move up last month, we saw spreads narrow, right? I mean, we actually saw yields come down for high-grade corporate debt and high yield in some cases. That's a sign of healing in the credit markets. I think what you're seeing in the Treasury market is in part a flight away from quality and into some of these asset classes. That's where we've preferred to take our risk. In the corporate bond market, we find very attractive yields there. You're seeing more money move into there and out of Treasuries. No doubt Treasuries are in part reacting to the outlook for issuance.
In effect,
but I think a lot more has to go with.
In effect, Treasury rates are rising, but corporate rates are falling.
That's exactly the point, Larry, which is why it's a sign of healing.
Peter Schiff,
absolutely.
That's got to be a good thing. If all rates were rising, yeah, I'd say that all hell's breaking loose, but it's not. Corporate rates and spreads are narrowing across the board, short, medium, and long, while the Treasury rates are rising. I would say that's a shift into some risk-taking.
Well, we'll see how long that lasts. I mean, it's my thinking that all rates are going to rise. Sure, I think the spreads are going to narrow between corporate bonds and government bonds, but ultimately it's going to happen in a rising interest rate environment.